Well, the markets look uneasy as we await quote unquote Liberation Day, the day where we're going to get an expansive announcement of what could be a vast remaking of U.S. trade policy, what could be a centerpiece of the economic pivot that we see with the new Trump administration, what could be a negotiating tactic, what could be something that ends up lifting the markets or sinking them. And the operative term there is could be, because the lay of the land here seems to be that we really don't know what it is shaping up to be. And this is what we're going to talk about here today on Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. The question before us, of course, because as ever, as traders, we cannot tell the future and have to try to figure out how to handicap a range of outcomes, is whether stocks, which have been aggressively beaten down in anticipation perhaps of what we have coming tomorrow, we'll see, whether that beating can now cease. Because, of course, as we know, when markets see speculation be met with reality, they discount that reality. Whatever adjustments take place we move on. So are we getting to a place where these markets are ready to bottom, or are we getting to a place where the pain is likely to multiply? This is at core the question as we head into this announcement, and of course have to trade around it with lingering uncertainty. And of course, uncertainty is forever the feature of trying to trade a future one does not know. And so even in this very tenuous situation, there is perhaps a trade to be had. And so let's break this down piece by piece. So, of course, looking at stocks here as a starting point, this is how the S&P 500 has responded as a kind of catch-all for market-wide risk sentiment and certainly Wall Street risk appetite. We can see that since the second half of March, we've had this precipitous decline. There was a little bit of a corrective rebound, obviously, here at the start of March to retest the underside of the range that we ultimately broke through along the way of these shattering 4 weeks. And we are now back to pretty much where we started. Those lows from earlier in the month is where we're once again kind of huddling around over the past day or two. Moreover, as we try to retest back through what was former resistance turned support, a kind of inflection zone right here, that's holding up as an upside barrier after we broke through it to the downside. So it's as if we got to a point of maximum concern here, and having had a little bit of relief, we've now returned to the decision point, the place where the initial sell-off stopped and where we have to make a decision now about whether the problem has been duly priced into the markets and we can move on, or if it has not. It's a parallel story for the bonds. We can see here that as stocks have been going down, so too bonds have been going up since the beginning of the year. And here also, since the beginning of March, the move ran aground, pulled back, and has now returned to that early March starting line. We're back to the early March starting line on the stock sell-off. We're back to this early March starting line on the bond market rally. Now, what is all of this about? Well, needless to say, The operative conversation is about uncertainty vis-a-vis tariff policy and fiscal policy more generally. Just today, we got the updated ISM Business Confidence Survey, a PMI survey. This is giving us the latest on where U.S. Purchasing managers who are at companies with the task of looking forward, anticipating economic activity, and thereby figuring out inventories, figuring out staffing levels, figuring out how much capacity is needed. And so in that this is their vantage point, they are useful to poll about where the economy appears to be heading. This was where they were in March, according to this particular survey, this Institute of Supply Management survey. And we can see there was a contraction in the manufacturing sector here as expected, and a faster one. This index operates around a center line at 50, where that's neutral. Above 50 is growth. Below 50 is contraction. And here we are below 50. The further you go below 50, the faster the contraction. The further you go above 50, the faster the growth. So here at 49, we have contraction, and it's faster contraction than what the markets anticipated at 49.5. We're going to get the service sector update later this week, but for now, here are the internals of the manufacturing side. They are, in plain English, scary looking. This surge in the prices component, suggesting what the input costs are and what the pricing structure is in manufacturing, point to the fastest inflation since the middle of 2022, which of course was near the peak where the Fed's firefighting finally started to have an effect in the second half of that year and inflation started to come down. So a blistering rise in prices, even as we get contraction in both employment and new orders, and indeed the fastest contraction in some months. So what does the report make of all this? Reading directly from the ISM report, quote, demand and production retreated and destaffing continued as companies responded to demand confusion and price growth accelerated due to tariffs. In parallel, we got a revision of a similar PMI report, this one from S&P Global, same type of data, again, centered around 50, all the same rules apply. But this one from S&P Global, in fact, this was the survey that really kicked off these concerns for the markets when it started to report this slide in not just manufacturing, but the service sector, and with it, the overall economy. So these numbers, it very interestingly show a front running of the tariffs and manufacturing improving against that back story, and now turning down to basically standstill. These numbers initially had a slight contraction when they were preliminarily reported, and these are the preliminary numbers for services and the composite that will be revised later this week. This is the final number that was reported today. It's a little bit better than the ISM one in that the ISM one is contracting and this one is basically flat, showing manufacturing is essentially stalling. But it was this survey that showed us that what we've been seeing is a sharp decline in service sector activity, and the service sector is a much bigger part of the overall economy. As we can see, the composite that includes both manufacturing and services basically follows services because it is close to 70-80% of the economy, depending on when you look. And so when we look at this, then this was where the markets really started to get concerned. They said, it isn't that we didn't know that there were tariffs coming. It isn't that we didn't know that a retrenchment on government spending is coming. We knew all these things back in November. What we didn't know, and what we continue to not know, is implementation. To the extent that tariffs come on and they come off, plans change frequently, the nature of the expansive, broader plan continues to be clouded. And so what that's doing is it's telling businesses, don't spend money, wait for the environment to become clear so you can make your 6-month, 12-month, 24-month inventory, staffing, investment decisions. And what that's obviously done is it's ground activity to a slower level. The same thing, of course, showing up on the consumer side of the ledger. Here, consumer confidence has fallen off and inflation has surged. Again, around the same story. The respondents to this survey from the University of Michigan are universally citing that, or at least in mass numbers, universally is probably too strong a word, but in mass numbers citing the issue around tariffs uncertainty as part of these decisions, and suggesting that what the tariffs will do is they will boost prices for things, and so much as a tariff is basically a consumption tax on imports. And so we have seen a surge in inflation expectations back to 5%, again, near the peak from mid-2022. Notice the extent to which this lines up exactly with what's going on in this ISM manufacturing survey. And confidence has, of course, fallen off back toward the lows of this inflationary cycle. It was once inflation started to come down, the expectations started to come down, and once those started coming down, sentiment started to improve. Well, we're back toward the starting line here, both on current conditions and on expectations. And of course, with current conditions, it's a little bit better. With expectations, it's a lot worse. And overall sentiment, subsuming both indexes, lies somewhere in between. In response to all of this, the markets have of course, concluded, especially after the administration has dismissed their concerns, that the relief is going to have to come from the Fed. And so what we've seen is a significant dovish shift in policy expectations, again, since mid-February, as all of this started to hit the fan. You'll notice this looks quite a bit like what the S&P looks like here, a sharp down move and then consolidation after a little bounce, then back toward the low. Consider how much that looks like this, a sharp down move, a quick bounce of relief and consolidation back until you come back to the low. So what you're seeing here now is 73 basis points in rate cuts for this year. That's 3 cuts effectively baked in. 31 basis points for next year, at least 1 cut, and some chance of a second, about 6 basis points in the direction of a second next year. In all, 104 basis points in easing being priced in, whereas at the beginning of this move, we were looking at maybe about 50. And at the start of the year, maybe somewhere between 50 and 75. And so with that is how we look at what comes next and the market reaction. So we can see here that initially all of this looked like a growth scare. That, of course, comports with falling inflation expectations, falling yields, and a falling dollar, anticipating Fed rate cuts. But what we see now is more ominous still. Inflation expectations have started to come back up. Meanwhile, yields remain depressed, and the US dollar is hovering near its lows. So we appear to be looking at the very issue that the Fed was highlighting in its most recent update of economic forecast. This is the latest set of numbers, and the Fed was very clear, saying, we don't know what this is going to look like, much as nobody else appears to, but we do know that historically tariffs are bad for growth, and tend to boost inflation. So what we're going to do is we're going to increase our inflation expectations for this year at the headline 2.5 to 2.7, 2.8 at the core. Next year, an increase as well. And we're also going to lower our growth expectations from 2.1 to 1.7, from 2 to 1.8 next year, and even a little bit out to 2027, although by that stage, it's really very difficult to forecast. So those are very loose numbers, as it were. And so the expectation for the markets, ostensibly then, is the relief valve to all of this, at least that's what the markets seem to be saying, is more easing. Because to the extent that tariffs hurt growth, they are going to lead interest rates lower, because that lower growth will pull down on inflation and give central banks more room to cut. In fact, if we look at the policy expectations for a whole range of central banks for this year, we can see that for all of them through this period, the outlook has become various versions of slightly more dovish, be it the Bank of Canada or the US or the European Central Bank, even with its recent rethink of what may happen next year around the inflationary impact of defense spending, and of course the euro's rally around that. Nevertheless, all of the expectations for this year, against the backdrop of all of this tariff uncertainty, all of them have moved toward more dovish settings, with the exception of the Bank of Japan, where rates are moving at such a snail's pace and are so low relative to everybody else that we've gone from a slight bias to hikes to basically standstill on expectations through all of this. So modestly dovish in that we have stopped the incline here and shifted to neutral, but considering how low rates are here, that's enough of a shift to give you symmetry with the tone that's going on here. And therein, then, is the trading essence of what comes next. Now, the problem for the markets with these tariffs, as we've alluded, isn't that they are coming. It is that nobody seems to understand what exactly is it that is coming. The president has talked about reciprocal tariffs. And the idea isn't so much that it's just tariffs, but reciprocal trade barriers, meaning that he would like to mirror U.S. trading partners' policies back at them. That is to say, if a country is applying a certain tariff on the U.S., we want to do exactly the same thing in reverse, which sounds sensible in theory, perhaps, but what that actually means is a complete black box. For example, The Economist anticipates that if we actually went tariff for tariff with each trading partner, we'd have 2.3 million new taxes. Just new tax rates, new tax numbers to keep score of. If instead of targeting individual policies, we said, okay, we're going to normalize average tariff rates. So if a certain country has on average XYZ tariff rate, we're going to try to do the same. But how does that account for non-trade barriers like quotas and punitive regulatory barriers that some countries have, all countries have against one other trading partner or another? And how does that factor into this? Because the president has said he wants to have reciprocity there as well. How do you calculate an effective tariff rate? Do you just put a blanket one on everyone? That's kind of what we have now. We have a single external facing tariff for everyone, irrespective of the trading partner. And maybe what all of this means is just an increase in that. Nobody really knows. Moreover, it's unclear if these tariffs are a negotiating tactic. That is to say, they might get negotiated down, and so whatever is announced isn't the final answer. or if they're an attempt to, in a long-term way, remake the system all in one shot, and this is that announcement. If you look at the conversations that have been had between the U.S. and Mexico and Canada in recent weeks, then you know that renegotiation can happen with a phone call and changes can be swift. So is there really more uncertainty here even after this announcement, or isn't, seems to be the crux of the matter. All of this consternation in business and consumer confidence surveys is, again, rooted primarily in uncertainty, not in tariffs as such. Them we've known about for a long time. And so the key here then is, does this Liberation Day announcement give the markets and consumers and everybody else looking something solid to extrapolate over time, and on that basis to take action? If the answer is yes, then perhaps stock markets can find a way to like it, at least in the diminishing uncertainty of the environment. But that there is tariffs is itself a growth scare. And that might beckon more easing. And in that sense, bonds may keep going higher all the same, because of the expectation that whether the environment is certain or it's uncertain, the Fed will have to do more heavy lifting on the growth side. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. As ever, today, in just 30 minutes' time, as it is every Tuesday, I'll be on with Victor Jones for the Price of Truth. I am on with Chris for Futures Power Hour this Friday, back with Victor and Tom for First Call this coming Sunday, writing for the News and Insights portion of tastylive.com, commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Happy trading. Macro Money's back tomorrow.